title of that ISLA-led session, which shall be subdivided into 2.5 segments. The overall theme is really about, how securities lending is moving center stage, and clearly, it's a match made in heaven, ESG and securities lending, not only, but in part because of the power, the pent-up power, pension voting and asset management voting. And so we're delighted to have you guys with us today. I will hand over the microphone to my esteemed colleague, Andrew Dyson, in the city of London. Andrew, the floor is yours.
Nick, hi, and good morning, everyone. Hopefully you can all hear me. Great. Okay. So Nick, many thanks for that very kind introduction. Listen, I'm going to be quite brief because actually we've got quite a lot of territory we want to try and cover over the next hour or so. Obviously, ISLA's delighted to have partnered with World Pensions and the work that Nick's doing more broadly as part of these sort of 2-3 days of sessions. I was just listening to the last session while I was waiting to join, which was certainly talking about ESG, and as you'll perhaps learn over the coming minutes, ESG is at the front and center of much of what we're doing within the securities lending world. We've nominally divided up our time into an initial panel that my colleague Tina Baker will be hosting, talking a little bit about securities lending more broadly, some of the challenges and issues that we see, not just within ESG, but more broadly in terms of market liquidity and the role we play in the markets that we support. We've then got a presentation from a colleague called Stephen Yeats, who is the UK Chief Investment Officer and part of the global head of fixed income beta solutions at State Street Advisors. So his perspectives a little bit later on in the session will be fascinating. And then at the back end of the session, myself, Xavier and Sarah are going to be, I guess, picking over the bones of the earlier discussion, but also focusing very much on that ESG debate. Sarah, I see you're online. You're more than welcome to stay and actually participate in this part of the session that Tina's going to be hosting. But obviously we will be focusing a little bit more on some of the things that are closer to your agenda a bit later on, but please feel free to stay part of this discussion as well, because we may then use the final session to round up and just pick over the bones of what we've been talking about. I'm going to stop now because those of you who know me well will know that I have the ability to talk for the rest of the hour. We don't want that. I'm just going to hand over to my colleague Tina Baker, who is head of our legal services at ISLA, and she's going to be working with the group, leading the group through the next sort of 40-45 minutes, just looking at securities lending markets more broadly. So that's it from me. Delighted to hand over to Tina now. And Nick, I'll jump back on at the end of Tina's session just to introduce our next speaker. But Tina, over to you.
Many thanks, Andy. So thank you very much for inviting me to moderate this panel this morning. We've got quite a packed agenda and obviously our time is ticking. What we're planning to cover today is a very brief overview of securities lending, a quick roundup of the activity this year. We're going to touch on ESG issues, but obviously, as Andy has already stated, that there will be a follow-on panel after ours. And then we will have a quick chat about business for 2021, obviously time permitting. So I'd like to start off by just asking my panel to briefly introduce themselves before we start on our first topic. Thank you. So over to Ernst.
Hello, I'm Ernst Dolce, so I'm the head of liquidity solution for AXA IM. So we have roughly 300 billion now lendable assets.
Thanks, Ernst. Xavier?
Good morning, Xavier Bouthors. I work at NN Investment Partners, the asset manager of NN Group. And my responsibility at the NNIP falls under collateral optimization and securities lending and short-term funding.
Thanks, Xavier. And Maurice?
Hi, Maurice Leo. I'm a member of the EMEA Origination Relationship Management Team at Deutsche Bank Agency Securities Lending.
Brilliant, thank you. Finally, Ricky.
Hi, thanks, Tina. Yes, Ricky Smith from JPM, Collateral Services Product Manager, looking after the tri-party collateral management agency offering that we have.
Okay, brilliant. So as you can see, for varied participants and all part of the securities lending value chain. So I'm going to ask Ernst and Xavier just to briefly describe how securities lending fits within their organisations, and also to perhaps tell us why it's such an important activity to them. So can I kick off with Ernst, please? Thank you.
Yes. So first, liquidity, the way that we approach the security lending is more as a liquidity tools. And within these tools, we have the capabilities that we offer to our client. So we can approach it. So what is very obvious is to generate additional revenues. So we have that. So because, for example, we have clients that are pension fund, insurance company, but also UCITS fund where we are trying to generate an additional income for those portfolios, for those clients. But also we have the second part of the tool, like a risk mitigation tool. So I can give some example. We have some portfolios or some, I would say, strategies where the client wants passive investment, but they have derivatives and they do not have the assets to post as collateral. So we will use some collateral upgrade techniques in order to source these assets for them. The same thing for high yield portfolios. So that will be more like the leg that we use as a risk mitigation. And after that, we have the third part that sometimes it's a bit complex, is more like to try to remove what we call liquidity trap. So it will be, for example, creating a liquidity pool where for some portfolios or from balance sheet. So we'll move assets between a portfolio and balance sheet. So I would say for my organization is very important because the way that AXA, that is an insurance companies that use insurance companies or pension funds use a lot of derivatives, but we have a lot of other clients, third party, that are pension funds and insurance, for which they need to at the same time manage their liquidity, short-term liquidity, generate additional revenues, and also to cope with, I will say, the changes in the market environment. So we use security lending as a liquidity tool, but with a set of services within.
Thank you very much, Ernst. How about you, Xavier?
It's very similar to Ernst. So we also manage like different type of portfolio from UCITS, portfolio, equity, fixed income, but also like insurance portfolios. And indeed, so there's two legs of our sec lending program. One is to generate alpha, so additional revenue, but the other one is also to serve as a short-term liquidity provider. So obviously, when UCITS portfolio have a certain type of restrictions, that their focus would be mainly on the alpha and the income generation. And the other one where you have long-term investors like pension or insurance companies would be to serve as revenue generation, but also liquidity provider, short-term liquidity provider. Some of them are large derivative users and clearing and not clearing. So we fully also integrate sec lending with our optimization of collateral, because we see there's, since clearing of auxiliary derivatives started, we see an increased need to mobilize assets for collateral purpose, for mutual margin, either in bonds or in cash, but also variation margin, so funding needs in cash. And sec lending plays an important role to generate additional revenue, also lowering the cost that we face for clearing of OTC derivative, but also is an important tool for short-term liquidity needs for variation margin in cash. So depending on the asset type and the client, it's an important tool that we are using.
Perfect, many thanks. So Maurice, I just wondered if I could ask you to provide maybe a little bit more information about how, in your role as an agent, you support these features of the business and the value that you bring to clients.
Sure, thanks, Tina. I guess there are exceptions to some of this, but for the most part, agent lenders sit there are situated as an intermediary between the supply on one side of our industry and the demand on the other. By supply or inventory or lendables with multiple terms for the same concept, like ESG, you know, there's about $24 trillion worth of bonds, equities, ETFs, etc., enrolled, typically controlled by institutional investors such as pension funds, state, corporate funds, sovereign investors like central banks, future generation funds, and more regulated products such as insurance companies and mutual funds. And if the audience wants any more sort of binary information about that, ISLA produces a very informative semi-annual market review, which looks at the ownerships across supply and demand across those different institutional investor types. I would highlight, for the benefit of this audience, pension funds control something in the order of 25% or 6 trillion of that number that I mentioned. And they control about 35% of actual loan balances, which are about 2.5 trillion. So they control a little under a trillion in actual loan balances. So they are the second largest source of supply in our industry, and they are the largest owners of the actual loan balances that are outstanding on a day-to-day basis. The other side of the equation from supply is really the demand land. And on the demand side, you typically have banks who are looking to borrow highly rated sovereign debt, very often to meet their prudential regulatory capital needs. So these are global financial crisis regulations that require them to hold cash or near cash equivalents, typically on term, to be able to withstand a liquidity shock. That demand gravitates towards a lot of the pension fund and sovereign investor supply I mentioned. And the other source of demand is really is from broker dealers, and in their capacity either as market makers or as prime brokers feeding underlying hedge fund clients and providing that supply to them. So where does the agent fit in? The agent is effectively an aggregator of supply, and that gives ease of access for the borrowers on the demand side. It also provides more stability, and typically that service involves an institutional investor outsourcing the day-to-day activity, not the governance of the program, but effectively availing of the legal infrastructure, the trading capacity, risk management, settlements, the type of work that we do with Ricky in terms of collateralization, et cetera, on a day-to-day basis. And importantly, where the value comes from, Tina, to wrap up, I guess, it's the ability to outsource that to optimize the value of a portfolio, or to some of Xavier and Ernst's point, the liquidity, performance and optimization of the portfolio, depending on what your motivation is. And doing that typically under an indemnified structure, whereby the agent lender will most commonly offer an indemnification that says, in the event of a borrower default due to insolvency, we will liquidate your collateral and we will seek to buy back your securities and put them back in your custody account. If there's a shortfall between those two values, that's where the indemnity, or it's a sort of a credit insurance wrapper, applies. And that's something that for pension funds, I think, has a significant weighting in terms of risk management.
Brilliant, many thanks. That's a fantastic overview there for us all. Ricky, finally, could you just maybe give us an update or an overview as to how the tri-party collateral manager interacts with the other participants in the chain? Thank you.
Yeah, sure. So as the name kind of suggests, right, we provide an agency service that supports not only the safekeeping of assets, but also the margin management and the optimization of collateral for the entire securities financing market. It's both for the securities lending and repo trades predominantly. Now, these collateral requirements as such arise from the variety of the underlying securities financing transactions, and include those traditional products such as lending and repo. However, we also support structures such as secured funding and other margin requirements that are a result of derivatives activity, as we've seen with the UMR developments around SEG-IM, the need to segregate and post initial margin across counterparties. These structures are now being able to be expanded to include that type of activity as well. Now, the tri-party program itself, it brings together multiple borrowers and multiple lenders onto one single global platform. It enables, therefore, the seamless exchange of collateral to meet those underlying margin requirements and obligations that they have across multiple net effective bulk trade level detail. And again, many benefits, therefore, in able to do that on one single platform across multiple counterparties is operational efficiency. So you can generate huge scale through the valuation and testing of the collateral to ensure that it meets the lender's eligibility requirements that they will have in terms of what forms of collateral they're receiving as non-cash is acceptable. Now, to do this on a bilateral basis, it's a little bit tricky, especially when you're using equities in terms of the valuation work that has to go on, the recall over record date, etc. All of these different types of asset servicing functionalities, which you generate, the tri-party agent adds a lot of value here. Additionally, as well, those exposures whereby pre-collateralization has to occur in order for that underlying securities lending transaction to settle in the market. So it's very, very important that this happens quickly, as efficiently as possible. Reporting will go out to both sides to let them know that the collateral has been successful and then the underlying loan can occur once that they know the counterparty risk has been mitigated.
Great, many thanks, Ricky. I would just point out that I am conscious that, you know, obviously this is a fairly quick session this morning, so we may not be able to take questions as we go, but obviously we will be able to respond to questions after the event if people have them. So I think we'll just move on to our next topic, where we're going to have a quick discussion about some of the events and what our panelists saw in securities lending in 2020. So I'm going to put a question back to Ernst, please. And I just wondered if you could maybe give us a flavour of how the global pandemic that obviously has taken on all this year and what effect that's had on loan balance and your business mix this year.
Well, I will say two things. On one hand, it was pressure. I will say that because of the price volatility, the spike in the volatility and the collapse in the equity value, that create high demand for HQLA. So what we see, the demand went up. Also operationally, stress on obviously on the operational setup, because you have the settlement, and thanks to tri-party agent setup, you avoid a lot of issues, I will say, like that if you have a tri-party agent. But I will say that it's what we saw. What I will say, the global impact, where I will say that the ECB or the government that reduced it by putting huge cash and huge, I will say, liquidity in the market, that pushed down the value, the fees, the borrowing fee. So clearly we have a downward pressure on the fees that are paid by the borrowers. That is what we saw in the market.
Okay, thanks, Ernst. So Maurice, what are you seeing? And obviously you have a very broad range of counterparts that you deal with. And what are you seeing in terms of demand coming from the borrowers? And how's that changed this year?
Yeah, I guess some of the demand for equities that historically sort of gravitates towards Q2, we saw significant differences this year in shareholder distributions. There was some of that migrated towards Q3. I think some of that event in specific to 2020, I think we're likely to see some return to normalcy on that front, I think, in 2021. On the fixed income side, I think Ernst mentioned it, certainly running into the end of Q1, where tension started to emerge, particularly in Europe, as a result of sort of public health crisis. We did see significant sort of flight to quality and an increase in spreads and fees that higher rated sovereign debt could command. We saw something of an abatement during the summer, and we've seen a return sort of across October, November to increased demand as people position probably towards year end a little bit, but increased demand for highly rated sovereign debt. On the client side, the reaction was quite different to 2008 and 2009 because it wasn't a counterparty credit situation that we saw this year. I think we saw a much more balanced response from lenders. So we saw very little sort of pullback to the sidelines from lenders. And I think anybody who did return within a 1 to 3 month period. So a much more balanced approach there. We did see rebalancing in portfolios. So clients suddenly found with significant equity pressure on equity valuations that some of their asset allocation thresholds have been, they needed to rebalance portfolios. And then the inverse of that took place at the end of Q2, Q3, when equities recovered, found themselves having to rebalance once again. So it was important then. And then I think the other point, I think both Ernst and Xavier touched on, the focus this year has been less in new business and sort of RFPs around people changing providers on the traditional securities lending and revenue motivation. It's been much more around liquidity and the lessons from the end of Q1, having contingency repo and contingency facility, whether you do that internally or whether you choose to, excuse me, to outsource. I think that's where we've seen a lot of activity, both in dialogue with clients and prospects, but even across central banks. We've seen the Fed stand up the FEMA, which is basically a facility to allow foreign and international monetary authorities access to the repo market, to repo treasuries into the Fed because of the sell-off that happened in Q1, tail end of Q1 and the pressure. And we're seeing similar facilities stood up with the ECB, with Bank of England, et cetera, and the BIS. So it's, I think liquidity has been the story for the second, well, since the end of Q1, I think that's been the focus.
Thanks, thanks, Maurice. So Xavier, could you maybe just give us a bit of a flavour how, you know, what the potential impact or things that you've seen in terms of profitability and revenue opportunities that may not have been there in 2020, or new ones that maybe have arrived?
Yeah, so mainly what we saw is in 2020. So like it was already mentioned in March with the COVID. So the COVID crisis starting and getting to its peak, a lot of volatility, so pressure on the equity, with some short selling ban around the world that impacted the opportunities, and less balance on loans, so less revenue from that angle. On the fixed income side, mainly looking at government bonds, core European government bond, but also US Treasuries. Definitely some opportunities on trade because of large demand from the market to access this type of assets. So we saw that at the end of Q1, it was a little bit softer during the summer, and then now approaching in Q4, approaching year, and we see again an increase in activity on this type of assets on a term basis to go through the end of the year. So this is where we saw most of the opportunity on the government bond side to access liquidity for our counterparties, but also for us to be able to access liquidity using our government bonds. Yes.
Okay, and finally, Ricky, I just wondered if you could maybe give us a flavour about how the collateral landscape may have changed this year in terms of maybe different changes of terms of asset classes and maybe and the volumes that you've seen.
Yes, yeah, definitely. So traditionally at JP Morgan, the sort of composition of the non-cash collateral within the tri-party program traditionally sits around 60-40 in favour of equities versus fixed income. However, during sort of the height of the pandemic in March, there was a shift more in favour of fixed income. So the book looked roughly 55% to 45% in favour of fixed income. Again, to echo some of the comments already made, the largest driver behind that is obviously fixed income assets appreciating, equities devaluing. But additionally, well, as I mentioned, the longer sort of term trades were booked and put on. They obviously continue to stay open and remain open as we speak now. The collateral requirements have remained high. So as the equity prices are coming down, the topping up of the margin requirements has then therefore come through via fixed income instruments. Now, as we start to rebound and the equity markets have some form of repair, we have seen that get closer back to the 60-40 split, which we're used to traditionally. And given that's the kind of then indicator that equity values are starting to increase and clients are able to use that collateral source again, and sort of switch back almost to a pre-crisis levels. But other sort of collateral types we're starting to see an interest in the industry are ETFs, whereas traditionally, I suppose over the past sort of 5 years, due to the industry having there's a perceived lack of liquidity in ETFs, mainly due to a lack of understanding, lack of knowledge around ETFs themselves, where we are seeing sort of increased demand from definitely both borrowers and lenders to accept ETFs as collateral within the program. And there are certain vendors out in the market that are actually providing collateral lists to make it a lot easier to have an accepted list of ETFs that are sort of eligible as collateral, want of a better word. I think just to touch on the point, I suppose, around the legal structure of the tri-party arrangement. So collateral normally traditionally moves via a legal transfer of title. So the full beneficial and legal ownership moves from the collateral provider to the receiver. Given where we are with Basel III and capital requirements, RWA, etc., we're seeing benefit from the borrower side of the community, so the broker dealers, in being able to post the collateral via a pledge mechanism, whereby the excess collateral itself remains the property of the borrower, and therefore the borrower is not expecting to a regulatory capital charge in relation to that excess, therefore presenting sort of considerable cost saving. Now, ISLA have done a lot of work on getting a GIMSLA pledge document in place, which helps then on the collateral side for us to be able to take that in and support that on our books and records. So that's something we're seeing a shift in as well, with sort of challenging the traditional terms. And then if we sort of just from a global perspective, if we look at Asia, there's been a breakthrough in the China Stock Connect market, which again has seen an uptick in demand and increased activity as we expand our sort of global footprint, as well as increasing markets such as Taiwan and Korea, and also JGBs. JGBs continue to brokers have the ability to fund JGBs at a relatively low cost, so they're very attractive at the moment as a source of collateral.
Great, that's great. Thanks, Ricky. And I can just add that on, obviously you mentioned the pledge and the work that ISLA have done in this area. We are conscious that obviously it's part of a, there is an education process as well for beneficial owners who may be looking at moving away from a title transfer environment to a pledge. And I think in 2021 we're planning to do some more update sessions and to help on the education front there. So obviously please keep an eye on our website and more to come on that. I'm actually now going to move on to talk about the ESG, because I think obviously for this session I think there'll be a lot of interest. We've done pretty thorough feedback on 2020. So I'm going to start with Ernst, and the basic question we would like to understand is about the priorities and how you're seeing the priority of around ESG within your organization at the moment.
I would say that most of the work have been done not this year but the previous year on the ESG. For me, ESG it's more a reporting exercise now than anything else. The way that we approach it, I will say all organizations already develop their stewardship in ESG and continue to grow their investment. But for the security lending activity, when you are performing that on day-to-day, for us, it's a set of policy that you have to respect. And it's nothing else than a set of guidelines that we have from a different type of client, pension fund, insurance companies, or within the UCITS fund that we have to implement and take into account. So we have been doing that, but I would say the shift is because this activity grows, we have to do more reporting and we have more requirement around reporting. And so you have to find a way, because it's not the same constraint, try to optimize and reduce the cost of reporting. I will say that's the part that I see. After that, obviously, you always have those thematic about ESG and security lending. What we spend time also, it's in terms of education and training to make sure that I will say our investors, our clients, and also our sales team internally understand that those activities can work together and work really well when you implement and communicate well around those ones. So I have one figure that I like mentioning sometimes when we have that question about if ESG and stock lending, security lending works together. If you will remember 2019, it was the highest decade in security lending, and ESG was around. So it was more than 10 billion of fees that year. So I think it's something that we will continue to improve on, because we have to improve the reporting. The reporting is sometimes time consuming, but that's the only thing I see on the ESG on our side.
Thank you. And Xavier, I just wondered if you found that ESG considerations have had any impact on your program today, and how you might manage those.
Yeah, it had an impact, because like Ernst mentioned, so ESG is it's not in all the strategy, all the portfolios. That means like if a portfolio participate in sec lending and the portfolio has an ESG angle, then the sec lending has to also embrace the ESG parameters of the portfolio. So what it meant for us is making it more visible that ESG was already integrated in sec lending. And why do I say more visible? Because it's, Ernst also mentioned, it's already part of it. So when it comes to voting, restricting a securities, recording securities to make sure that it doesn't go out on loan, so you can use the security for voting, that was already embedded in the sec lending for many years. So, but now you have to make it visible. Exclusion, so excluding certain type of activities or issuer in your collateral pool. That's something that was already part of a sec lending program for many years, but now you have to make it visible. So because it's also all part of the reporting on the ESG integration within sec lending. So, and again, I fully agree with Ernst. It's all about also education and communication to a wider audience, from clients to sales team within the organization, to explain how the two activities can cope together and can live together, because they can live together. There's nothing that prevents sec lending and ESG to work together.
Thanks, Xavier. And I'm just going to hand over now to Ricky to say, can you let us know if there's been any sort of challenges with collateral management in terms of ESG, or any areas that you think need to be addressed, which will obviously help the industry to develop?
Yeah, definitely. So I think integrating these principles, these ESG principles we discussed, into the tri-party process does present many challenges. So if you think of investors who are lending highly rated ESG securities, they're going to expect to receive highly rated ESG securities as collateral back the other way. Therefore the ESG, the screening of those ESGs becomes especially important to avoid lenders holding the so-called sort of brown label or low rated stock. Now, like most things, I think standardization and automation are very key in this. So what I mean by that is that lenders can restrict collateral on an ISIN by ISIN level, but which is, I suppose, feasible to do, but not sustainable in order to, as the list will continue to ever grow. So I think what we need in the industry is standardization and automation in order to be able to support this. Now, whilst we await the official release of the EU-wide taxonomy, which I believe will come at some point next year, it's the objective really of the newly formed management steering group at ISLA, where we're going to look under the bonnet of this and try and get in place an interim best practice for the industry. Now, this working group or steering group as such will be represented by all areas of the financing ecosystem. So we'll have our tri-party collateral agents, lenders, borrowers, and also reference data vendors and providers. So we can try to come to some common form of standardization, and therefore being able to have almost collateral lists similar to what we have in the ETF space would go a long way, I think, in coming up with an industry best practice interim until we get that EU-wide sort of defined taxonomy. And then that feeds in quite nicely, not to steal Andy's thunder, obviously, but there's an ESG steering group at ISLA as well, which this collateral management steering group will feed into, so we can sort of work towards a common goal.
Great, and I think you point out the working groups that ISLA are running, and obviously we've had a huge amount of interest in these groups, and it's right that obviously members will be directing us on these initiatives, and obviously we'll come out with best practice and standards from those groups, which is key. So Maurice, finally, I wondered if you could maybe talk about what you're seeing happening as well. Are you seeing any funds deciding that they don't want to lend because of securities lending concerns, or about maybe perceived incompatibility between ESG and securities lending activities? I just wondered if you could give us maybe a bit of a flavour there.
Yes, I think to be balanced about it, the answer is yes, to an extent. There are certain funds. There was clearly a case around this time last year of a large fund in APAC, significant assets under management, that decided to withdraw from international equity lending. So stayed involved in local equity, stayed involved in fixed income lending, but felt that it wasn't compatible with their principles. That got a lot of media coverage. I don't think it didn't create any kind of momentum more broadly. I think there's also a constituent within the ETF community that I think we still need to work with, and it probably goes back to some of Ricky's points and Ernst's points around the ability to sell and position a product that has a securities lending wrapper within it, or a product that contributes to performance, but equally raises certain questions and the ability of a sales force to position that with pension funds, insurers, etc. I think that's an area, particularly sort of SRI benchmark products, that there's still a need. We haven't seen the kind of momentum there that we've seen in sibling and ETF products that are not SRI benchmarks. I would say on the flip side of that, when you look at the likes of an Norges Bank, for instance, who published a great paper back in 2016 that looked at their evaluation of securities lending across sort of three independent interplays. One, the value that securities lending brings to contribute to well-functioning markets. I think that manifests itself, even if you look at the way the ECB, central banks, with quantitative easing and the purchasing of assets in the market, they're very, very mindful of the need to recycle those back into the market through repo and securities lending to continue to ensure orderly markets in those assets. The Norge has also looked at, what is the actual return that comes from lending and the fiduciary responsibility to look at that. And the third is then, how do you exercise governance over companies? And I think they kind of said, most recently in a paper last week from Norges, which tracked 22 years of equity investments, there was an entire module on lending. And interestingly, they look at ownership risk. And they look at that, they evaluate it similarly to credit risk and cash risk. And on ownership risk, they believe that they engage with companies, they tell companies, we will lend stock. However, we'll exercise the right to recall that stock if we need to. And what you do there is you influence a company's behavior over time, as opposed to at a specific event around a voting event where you maybe need to exercise sanctions. So they also have a list of securities that 100 to 200 that they review periodically, that they exclude completely from their lending program. And I think there's a balance there to be found between the two, between those that are more sensitive for good reason, and those that can manage that exposure through either exclusions or recalls, but it doesn't have to be a binary in or out evaluation.
Thanks, Maurice. Obviously, we have got the next panel session coming up, so I don't want to steal all of Andy and Xavier's thunder for the next panel, but we probably will, time's ticking on. We've probably got a time for 2 more questions. So we did have a chat when we were preparing about what everyone was thinking about the outlook for 2021. So Xavier, maybe I can ask you, if where do you think you'll see the most business opportunities to grow for next year?
So the first one would be still on the fixed income side, the government bonds. So there's a lot of discussion around, like, will there be again like collateral scarcity on the market in 2021? So we also wait to see the ECB actions impact on the market. So collateral scarcity with collateral needs, funding needs. On the equity side, still to be seen. We see some opportunity also on the emerging market debt. There's definitely a need for the market to access emerging market debt for liquidity purpose, for well-functioning market in these countries. So this is where I see the most opportunities in 2021. And
Great.
ESG, of course.
Yeah, continuing topic, I think, for quite a few years to come. Maurice, obviously 2020 was also a year of regulation. We've had lots of, especially for securities lending, well, we had SFTR, CSDR rumbles on. What do you think will be likely the most important regulatory developments in 2021? Have you had any thoughts on that?
I think UMR, and Ricky may touch on this, I don't want to go too far into it, but I think UMR, as Ricky mentioned it earlier, phase 5 and then subsequent phase 6, I think that has the potential to influence and create demand around collateral transformation and the need to mobilize collateral more efficiently. So it's almost the competing uses of securities lending from a revenue perspective, maybe repo for financing, and just collateral moves within your pool, and where is the optimization of that reside. And I think that's where the industry's been focused, and the numbers on UMR 5 and 6 of entities affected, although the quantums are smaller for them, that is going to be a focal point. I think the other is probably Basel IV and the area of rules and limitations around banks being able to use internal rating models. So when you're dealing with non-rated entities such as pension funds or mutual funds, UCITS, 40 Act type funds, the risk weighting of those will increase significantly. Now that presents issues then as to whether a borrower wants to gravitate towards that supply because it's more expensive to access it because of the higher risk weighting. I think the emergence of services that can look at ratings, assigning ratings to those type of entities where they're not traditionally rated by the recognized rating agencies that we own in the industry. I think that is sort of a positive where we see the industry creating solutions to particular challenges.
We just to add, I guess there we may also see a pledge being offered as a solution, to fill that gap. Hence why we're going to look at doing some more education sessions on that and for next year. So I was just going to ask you, because I guess we can't have a panel this time of year without mentioning Brexit. So we just wondered whether you had any thoughts on what Brexit impact and changes are going to have on you and your organisation?
I think that it would be fair to say that we're quite thankful that they takes time to find a solution, and even they have not to find a solution because we had time to put solution in place. Because if you think about it, for security lending, we had in repo, we had a lot of repapering legal documentation, check that if the legal setup was in place, and after that, check also if the colleagues that move them from one jurisdiction to another, see how that will work. So I will say Brexit now, it's more like a wait to see on our side than a problem. I will say that all the setup, legal framework, operational framework, most of the participants in the market are ready. Maybe not ready in terms of the impact, for the unknown impact in terms of revenues, investment and positioning, but in terms of operational setup, legal setup, the framework is in place.
Brilliant, thank you. Finally, Ricky, any thoughts on collateral management priorities? I think you might have covered a few earlier, but anything else that you might want to add for your business in 2021?
Yeah, sure. So I'll just concentrate on a couple really. The focus is on really reducing settlement risk still, increasing liquidity whilst being able to maximize collateral availability for our clients. One of the key, not to quote a phrase, is collateral convergence. We're looking at the moment is how we can use the tri-party program of functionality to holistically manage a firm's collateral obligations regardless of the underlying driver of that. So to touch on the UMR point, a lot of buy-side firms are familiar with tri-party from a lender's perspective, but then also being able to potentially manage your initial margin initially, but then your variation margin requirements is kind of like the end goal, whether that comes next year or the year after. But having that holistic framework, one platform with the assets in tri-party, optimizing them across all of those obligations, it will be very key. And then I think secondly, a point to touch on is the digitalization work.
Yeah.
So where JP Morgan are looking at becoming a collateral token agent. And effectively what this means is we'll be acting as an infrastructure bridge between the legacy sort of market architecture and the digital space. So really the role that we'd be performing here is to seamlessly integrate those multiple digital components across the blockchain. It would involve coordinating the pre-collateralization of the trade, as well as the creation and the redemption of the tokenized asset on the blockchain, and really bringing it into sort of the future landscape as we see where the direction's moving in the next, say, 5 to 10 years. So it's putting in place those building blocks to enable us to then have a robust business model going into the future. And it was mentioned in the press recently in the US domestic market, JP Morgan just went live recently with an intraday repo transaction that was on the blockchain. Now, we added the role of the collateral token agent to this from a JP Morgan collateral services perspective, and it enabled the settlement and the maturity of the transaction within hours as opposed to days. So something we're looking to build upon next year, potentially release across other markets.
That's fascinating. And obviously, I should also at this point give a shout out for the efforts and the digital agenda that ISLA are working on with the development of the CDM and the ISLA clause library and taxonomy. There's plenty of information about all these topics on our website. So encourage everybody to take a look. But lastly, I think we're being called to time. So I'd like to thank all my panelists for today's morning's session, and thanks for joining me. And yes, I think we may be coming to an end. So thank you.
So Tina.
Andy's here, sorry. Hi, Andy.
Tina and the panel, fascinating discussion. Many thanks for that. I know, Xavier, you're sticking with us for a conclusion session, and Sarah, I know you're still online, but now we're sort of going to switch direction a little bit, and I'd like to welcome Stephen Yeats from State Street. Stephen's going to be with us for a few minutes just to talk a little bit about some of the broader themes around ESG and regulation that we should expect to see over the coming weeks and months. As I mentioned before, Stephen is a UK investment officer and global head of fixed income beta solutions at State Street Global Advisors. So without further ado, and there's obviously a lot more information about all of our speakers, both on our website and of course on their LinkedIn accounts. So if you want to learn more about them, please feel free to look them up there. But Stephen, I'm going to hand over to you right now. Thank you.
Perfect, thank you, and hopefully everyone can hear me well. So thank you first of all for this opportunity to speak to you all. I've got about 15 minutes, I think, to kind of run through a whole load of things related to ESG. And it's important to note that I'm going to come at it from a purely asset management perspective. So I'm not going to go off-piste into the area that you're all experts into, but hopefully I hope to leave you with some thoughts for your further discussions around how the asset management industry and how asset owners and are approaching this space. So I think there's four main areas I want to talk about today. The first is very top level and foundational, but important, is what is ESG? What do we mean by ESG? How do we think about it? The next is why now? Why is there so much focus on it now? And then thirdly, how do we have an impact as an industry? So how does the financial system feed into kind of broader environmental, social and governance aims? And I'm going to finish by kind of zooming in a little bit to talk about, you know, how in practice is this playing out? So what are we seeing in terms of the ways that ESG is being implemented within asset managers, within asset owners and other kind of market participants? But if I start with what is ESG? So for State Street Global Advisors, we're an asset manager, and actually our mission is to invest responsibly to enable economic prosperity and social progress, which you could argue is a bit of a mouthful, but what it really means is obviously what we're doing is investing capital on behalf of institutions, pension schemes, and ultimately, when you boil it down to what we really need to do is we need to serve the needs of those underlying owners of the capital that we invest. So it all comes down to who ultimately owns the money that we invest. And historically, and rightly so, and continuing, the underlying owners of this capital are extremely focused on risk and return, and will always be. So clearly a key function of an asset manager is to deliver risk and return outcomes that help these underlying owners solve the issues that they wish to solve, whether it's retirement or anything else. But increasingly they want us to, you know, they care about other things which are impacting society. Environmental, social and governance issues are clearly in central focus here. And so essentially, what that means is that alongside these risk return drivers, as asset managers, as market participants, we need to help, or these, you know, these underlying owners are asking us to help solve some of these issues, these broader societal issues that they face. So I think that's the kind of bedrock of everything that's going on in ESG. Now the question is, why now? Why are so many you know, market participants talking about this? Why am I talking about this to you right now? And you know, the ESG is not new. So you know, for many years, for decades, for longer than that, you know, there's been considerations around ethical beliefs built into the mandates that asset managers run. If you think back, you know, decades and decades, really, you're talking about screens around particular beliefs that certain asset owners care about. So these have been around for a long time. But I guess what's really changed in the sort of last 5 years and is accelerating is that ESG investing is going from kind of a kind of fringe or potentially more of a niche area to being much more central to what clients and the underlying owners of the capital we invest are demanding from us. And the breadth of the sort of issues covered by this is in some ways very, very broad. There are a broad range of issues that society faces now, which we could talk for hours about, which I won't, but which they're looking to help us solve. And I think if you look at where we are now with the COVID crisis, it's a huge reminder that at its core, this is a health crisis. It's a crisis that's hit society, and this is leading to increased adoption of ESG. So the environmental and the governance have been around for a long time, but we're seeing an acceleration in kind of the social element in ESG investing. The next thing I should say is obviously this social element has come to the fore, but let's make no mistake about it that climate change is the dominant thematic that we see in sort of ESG spheres at the moment. If you had to pick one theme that is really being focused on very deeply, it's climate change, and I'll come on to talk a bit more about that. But also, there's a huge change in terms of demographics going on. So at its core, as I said, all of this revolves around the owners of the capital. And if you look at what's going on at the moment, and what we expect to continue to happen over coming years, is that the ownership of that capital is changing. So there's a huge wealth transfer going on between the so-called baby boomers and the next generation. And some of the figures that we've looked at, suggest that in excess of $15 trillion by 2030 will be kind of changing hands, for want of a better expression. And so again, this is leading to changing attitudes around ESG investing. This new generation of owners of capital, you could argue, care more about some of the issues that are out there. And so they are really looking for change and looking for the industry to kind of play a key part in that change. So we're seeing this in flows, and we're seeing this in terms of the proliferation of ESG investing throughout the asset management industry, whether it's products, whether it's ESG integration, or any other angle like asset stewardship, which I will come on to. The third question, which I have, and I do only have 4, so I will get to the punchline, is the question about how do we have an impact. And as I mentioned, investors care about risk return, and we need to keep that at the fore. But they also care about impact. And I think the onus here is how we have an impact. And the reason we is so important is because if every single investor, if every single asset owner, if every single country and regulator has a different definition of what ESG is, how you measure it, how companies report it, and how investors report it, then the ability to have an impact is challenged. If you think about it from a company that we may own's perspective, they want to know what investors care about, and not only that, but what are the sorts of metrics that should be reported on. And if you have different investors, different asset owners, different regulators in different countries, all coming up with different definitions, different frameworks, then how does a company know how to change and how they will be measured? So I think at a basic level, that kind of sums up the challenge, which is a big one. The good news, however, is that there are many, many cross-industry, cross-geography frameworks being put together, specifically around transparency, which is incredibly important. I mean, transparency, if you measure it, you manage it, is the old adage. But it's incredibly important about how do we drive transparency, and particularly about having metrics and frameworks that are cross-industry, cross-geography. So there's many that I could mention. I mean, SASB do a lot of work on this. There's TCFD, there's a whole range of EU-based initiatives and around the globe, which are doing a lot of work on this. And the key, I think, for the success here is for, as I said, for countries, for industry participants to really coalesce around industry-wide frameworks that allow change and impact to be delivered. And importantly as well is across asset classes. I run the indexing fixed income business for SSGA, but also thinking about, again, how do you measure companies across asset classes, equities, fixed income, other asset classes? How do you have a holistic view of their ESG profile? So the final question, and it's probably the one I assume you're most interested in, is in terms of what does this all mean in practice, right? So And that's all about how are asset managers, how are asset owners integrating ESG. And I'd say when I look at the work that SSGA are doing here, I think of it in three ways. Firstly, it's about thematics. So there are certain themes which investors care deeply about, and these are things that they really want to zero in on. They're not the sorts of things that they want to weigh against other ESG elements of an investment. They're things that they care about and they really want to focus in on. So these thematics have been around for years, as I mentioned, in terms of ethical beliefs, in terms of controversial companies. They include things like controversial weapons, UNGC violators, but importantly, the super theme, and rightly so, is climate change. So that's something that is incredibly important, thinking about these thematics and being able to measure them, being able to either screen out certain thematics that investors don't want exposure to, or in the case of climate change, thinking about decarbonisation of your portfolio, thinking about not just decarbonisation, but also how am I allocating more capital to kind of help with the transition towards green economies. So not just kind of penalising in terms of removing exposure in portfolios, but also upweighting investments in areas, in companies that are doing more in terms of kind of the green transition, who have better governance, who are improving the industries in which they work. So I'd say climate change is one of those areas where it is clearly here to stay. It's clearly getting increasing focus, and there is an urgency around it. And when you actually look at the what needs to be done in order to kind of hit the scenario that we would like to hit, it's quite daunting. And so, like, I think you can see this call for action across regulators, across industry participants, and ultimately across society. So that's kind of the thematics. They're the first thing. The second thing is, how do you think about the holistic ESG profile of a company or a country? Now, this is different than taking a more one-dimensional view of the world. It's about balancing different ESG elements to come to a holistic view. Now, this is incredibly difficult because, ultimately, companies across different industries have different things that you would want to balance. A financial company is very, very different to a chemical company in terms of what are the things that you would think about. There have been some really good frameworks in terms of reporting. I mentioned SASB earlier, and essentially SASB, what they look to do is to have a materiality map across industries, which says, in each of the industries, what is material in terms of ESG metrics. And once you get a framework like that, which cuts across industries, which allows more transparency around metrics, you can actually start to build holistic views of companies around their ESG profiles. And that's really something that we are seeing accelerate, is having a way to measure companies' holistic ESG profile, and also therefore tilting exposures towards those companies with better ESG profiles away from those with worse ones. The final thing in terms of implementation is, of course, asset stewardship, which is a huge area. And again, given I've only got 3 minutes left, I won't get into too much detail. But really, again, it comes down to the basic landscape, which is that as asset managers, as asset owners, we are investing on behalf of the underlying owners, and they want us to use our ownership in order to drive change, to influence outcomes. And this is obviously where asset stewardship comes in. So in order to do this on ESG level, again, all of those things I've talked about in terms of measurement and transparency and metrics, they all count, because again, if you're engaging with companies, if you're engaging with other market participants, then really you need to be talking the same language. You need to have metrics that you can engage on, that you can track and monitor, and ultimately drive impact. So asset stewardship is a huge topic. I know it's a big topic for you as well, but I think it's along with kind of ESG integration into investment processes, along with tilting and screening and really allowing investors to understand the impact of the companies that they invest in, it's about also affecting change in the companies that you own. So again, helping influence these transitions that we've talked about in terms of environmental, social and governance issues. So I'll probably stop there. I've gone through a lot in a very short time. Again, unashamedly from an asset management perspective. But again, I think if I was to summarize, my train of thought here, clearly, as I mentioned, we think about ESG as ultimately the underlying owners of the capital we invest, what they are demanding from us, that it's risk return, but it's also some of these other issues, and they are linked. They're not kind of, they're certainly not operating in parallel from each other. There's a huge impetus now. We mentioned, regulatory, initiatives. We've mentioned the baby boomers and this transfer of wealth, and also, hopefully I've given you an idea of how some of the ways in which this is being implemented as well. So thank you very much for your time.
Stephen.